Welcome everybody to Jazz After Dark. How we doing out there? Hope you're having a good evening. Glenfiddich, day number 2, or night number 2, I should say. Whoa, that's a lot. Okay. That is what we'll be enjoying here today. What do you got to drink? Hanging out with us after dark. I really come to like doing these videos, actually. We're going to talk about some bad news tonight, though. We're going to talk about recessions, and I'm probably not going to give you the best of data. Sorry. But we're going to talk about it anyways. We're going to have a recession. I just want to share something with you, maybe teach a little bit along the way. If you're curious how this works, maybe you've heard some of these buzzwords. Yeah, maybe we can help you. So the reason why it's very likely that we're going to go into a recession is because the bond market has already predicted it. And historically, the bond market is accurate. Not kind of accurate, not sometimes accurate, not I got the best pick in the Super Bowl accurate, like 100% of the time. It is the only indicator that I know of, and I have spent well over a decade now playing with all of them. The only indicator that I know of that is 100% accurate, and I'm going to share with you here tonight so you can see for yourself and take the data for what it is instead of taking my opinion. Now, we're financial advisors here at Jazz Wealth, and one of the things that differentiates us is, number one, we're laid back. I mean, we're not trying to pretend like we're somebody fancy in a suit and tie, and you'll never see me around town dressed much nicer than the way I am right now. Any of us, for that matter, here at Jazz. The second is we live and breathe the stock market. We don't claim to be like professional traders or anything, but that's my background, managing a mutual fund. And so managing actually a lot of money for Chinese investors. And I just kind of fell into this business and I really enjoy doing it for people. And so most advisors can't say that. Most advisors are taught to sell mutual funds and, all this stuff. And so I just like talking about the markets and everything. And so I want to share some of that with you. And in exchange, I hope you'll keep us in mind at jazzwealth.com. All marketing aside, let's get to it. I'm going to use the example that I've used every time I've explained this, but in case you haven't heard it, let's pretend that you come to me and you ask to borrow money. The answer is no, by the way. But let's just say, hypothetically, I entertained the idea of lending you money. And you gave me the option. You said, you can loan me the money for 1 month, 3 months, 6 months, 1 year, 2 years, 5 years, 10 years, or 30 years. Those are the windows that I have to choose from. And let's make it simple. We'll call it $1,000. Not a big deal, right? For most people to lend money, if you're fortunate enough to be in that position, you're probably not going to respond with, sure, I'll lend you $1,000 for 30 years. I would opt to lend you the money for 1 month. Now, do you think that if I lent you the money for 1 month, I should charge you more interest or less than if I lend you the money for 30 years? It's kind of an easy question, right? If I loan you $1,000 for 1 month, the odds of me hunting you down and being able to find you are pretty good. Also, the odds of you defaulting on that loan in 1 month are not so high, right? Your life would have to fall apart in some way if it hasn't already fell apart otherwise. So we're going to assume that you're financially worthy of a $1,000 loan. Well, if you said, Dustin, let me borrow the money for 30 years, I've got some considerations there, don't I? If I loan you $1,000 for 30 years, I have to worry about inflation, that $1,000 and the payments that you're making to me. I got to be rewarded for that because otherwise I'm going to lose money. I also know that in 30 years, there's a lot that could happen to you. You could take up skydiving and not be very good at it and end up dead. So I'm taking a greater risk. There's also a chance you lose your job, find financial hard times. And so I realize that you paying me back over 30 years has a greater risk. I would like to charge you more interest. So for example, in the 1 month loan, I might say, give me 2%. You know what I mean? I I'll do it as a favor, so to speak, but give me 2% because I am taking a little risk, and that's probably fair. But if you said, I'll take 10 years to pay you back, I'm going to say, oh, well, we got to go a little more than 2%. And if you said 30 years, I'm going to say, well, we got to go a little bit more. And now you understand why. Well, the bond market is the same way. When you buy a bond, let's say they call them a note, right? So a 1-month note, you purchase it. There's not a lot of risk of the underlying issuer, the person that's selling you this bond, defaulting. And in today's example, I'm talking about the federal government. Supposedly, bonds are backed by the federal government no matter what. Nonetheless, if you take the risk of loaning the government money for 1 month, usually it's not, you're not worried about some real risk. If you buy a 30-year bond, would be called a bond in this case. If you buy a 30-year bond, there is more risk on your part that you may not get paid back. And it's really not so much that. It's that there could have been a better place for you to put money over a 30-year period. That's really what you're looking at. If you buy a bond, you say, well, I could have bought the stock market. Granted, there's risk there, but I need to weigh the pros and cons of risk-free returns versus whatever else you choose. And so normally the bond market, let's get to it, looks like this over here. So what we have, they're color-coded so you can see, and I just want you to focus on this part right here. The purple, and up here you can see the difference, the purple is the 3-month treasury or 3-month note. I'm sorry, I didn't put 1 month on here, but let's start with 3 months. It is less interest, or they are paying less, this is on the bottom of the chart, for loaning for such a short period of time. 6 months is orange, it warrants a little bit more. 1 year warrants a little more return, and 2 years, and 5 years, and 10 years, and 30. So you could see how that works. The shorter the time period, the less interest or the less the return will be. The trouble is, look what happened to this purple line. This is the 3-month. It should always be the lowest returning treasury. But look at it rapidly getting close to some of the longer term treasuries. And then right in here, all of a sudden, something weird's happening. And it continued. What's happening that's so weird right in here? The 3-month is now trading at 4.86%. But if you go to the 6-month, all right, that's normal. You're taking a little more time risk there, 5.06. We go to the 1 year, it's 5.05. Wait a minute, that's a little off there. That should be higher, but it's not. The 2 year, what in the heck? So you mean to tell me if I loan money for 3 months, I get 4.86, but if I loan money for 2 years, I don't get more money, I get less? In fact, if I loan money for 5 years, I get quite a bit less. 10 years, even more. This is odd. This is not what Dustin just explained. If I loan money for 3 months, I get 4.86. That's about 1% difference if I have to wait 30 years to make that annualized return. That's a bit odd. So you see what's happening there? We have disconnected from the norm. And that's what's known as yield curves being inverted. When you see that term, now you know, okay, well that's, now I've learned something there, right? So we have inverted yield curves. Does that really matter? Well, what it really means in the short term is the reason that those shorter term bonds and notes are more pricey, or not pricey, they yield a higher amount, is because fear of risk in the short term. We normally don't fear the short term, right? I just talked a minute ago. If I loan you $1,000 for a month, 3 months, a year, I'm not really fearful. But all of a sudden, the lender is extremely fearful that something bad's going to happen in 1 year or less. The bond market is saying that all the fear is right now and getting greater by the day. What fear would that be? Fear of an economic slowdown, fear of maybe higher inflation to where it's just not worth it to loan money out that long. We want our returns quickly because we fear inflation could get out of control. There's all kinds of different reasons why, but right now, the fears in the short term, and that's called, or the way we sort of visualize that, is called an inverted yield curve. Now, what we can do is we can now be a little more advanced. Remember, 2023, we're going to take that extra level, extra layer deeper. We're going to go one more step. We're going to say, okay, if the yield curve is inverted, how much is it inverted by? And to do that, you compare one bond to the other, or one note to a bond. So remember on that previous screen, I showed you the 3-month was going up. Well, if we compared the 3-month to the 2-year bond, we would find that the 3-month was had a higher yield. And it shouldn't be that way. But by how much? What was that spread? Remember, we were looking at one a second ago that had almost a 1% spread, the 3-month versus the 30-year. So we can actually plot this, and this is going to be a little bit of, let's go here to make it bigger. I don't know what this is. All right, so I'm going to zoom out here just a little bit because I want you to see, there it is. So the 0, and let's try to help you out and make this bigger. There you go, that's good enough. So the 0 represents there being no difference between the 10-year and the 2-year. So anytime this line gets to 0, it means that both of them are trading for the same amount. In other words, loan money for 2 years or 10 years, it does not matter, you get paid the same amount. Which one would you choose? If you knew that you were going to get the same amount on a yearly basis, you would choose the 2-year, right? Why take the risk over 10 years? There's no point in doing that. Okay, so now that we're under 0, it means that one is trading for more than the other. Right now, it means the 2-year is trading for more than the 10-year to the tune of 0.83%. So there is a spread or a difference of 0.83% in the wrong direction. Again, the bond market's saying, we're really fearful about the short term. Something is not quite right here. I'll do another one here because I did the work. You guys can spare me a minute, right? So we'll do another one. This is the 30-year versus the 5-year. So again, whenever the line is right at 0, they are equally the same. That's fascinating that a 5-year return versus a 30-year return would be the same. What are we going to choose? We're going to choose a 5-year all day long, sit back and enjoy it. However, we're below 0 right now. So the 5-year is now more costly than the 30, or not costly, it is more yielding more than the 30-year to the tune of about a 1/4 point. May not sound like a big deal, but that's not normal. Now, there's a saying in the bond market, if you want to sound kind of geeky in front of your friends, right? Are you learning a lot? This is pretty cool. This was really good, by the way. All right, so there's a saying in the bond market that every inversion leads to a recession, but not every recession had an inversion. It's not my saying. I don't know what to tell you. Focus on the first part. Every time there's been an inversion, particularly of the 2s and the 10s, there has been a recession. But not every recession was caused by that inversion. That's all that saying is meaning. So let's do something fancy here. Let's let you make the decision. I'm going to try to go up a little bit. This is, okay, there we go. We'll start with the 30-year versus the 5-year. In the background, the gray shaded area represents a recession. And in fact, that's the duration of the recession that we had back in 2008, all the way towards just the end of 2009. Here's the little short one during COVID. Here's the previous one, the dot-com bust that caused the recession. You're going back into the early 90s. The older you are, the more you'll remember all of these and remember the pain. But I want you to notice something. So let's just look here. So at this, there was actually 3 different times where the 5-year yielded more than the 30. In other words, we were inverted. Right behind it, you can see the recession. We come out of it, all is good. We're not inverted. Ooh, scary for a second. Nope, no problem, no problem. We go inverted, not just a few months later, recession. Right? We come on all the way over here, inverted. What was this? 6 months later, 7 months later, recession. Right? What's happening now? We're inverted. We're staying inverted. We're getting more inverted. Look at all of them here. Over here, we go inverted recession, go inverted, 2 back-to-back recessions. We can go back as far as we want. Every time we go inverted, we have led to a recession. Now, to be fair, most people, when they make that phrase, they don't say the 30-year versus the 5-year. That just happens to be the last one that I had up there. Most commonly, we look at where the stat or the saying comes from is the 2s versus 10s. And that's how you sound fancy if you want to say it there. 2s versus 10s. So if I plot that, here's the 10-year versus the 2-year. You can see the same exact thing. The trouble, I'll go over the trouble in a second, but inverted recession, inverted recession, inverted recession. There's not one time it doesn't do it. Every single time. This is just, how far are we going back? To 1976 for the moment. Here's the trouble. When the inversion is extreme, see how far we are away from the zero? I'm just simplifying the terms. I'm not trying to make this complicated, so please don't think I'm like drinking too much. The extreme pull away from zero, in this case 0.83%, is that normal? Is it over here? No, didn't go very far. No, didn't go very far. No, didn't go very far. This was all that mess from Black Monday, right? When the inversion is extreme, the recession is harder. It's not longer, it's harder, meaning it drags more on the markets. The response to it from now the Fed has to be more extreme. The pain that we feel in that recession is greater. That's what I worry about right now. I worry that the bond market is pricing in really bad news, and the Fed knows it, and the Fed's trying to sound in control. Maybe they are, I don't know. I'm not gonna, bash on them, but it's not looking good for that. Now, I'm still on team soft landing, where I believe that yes, we will have a recession, but it will be very light and it will be very controlled due to what the Fed is doing. I'm an optimist and I believe it. I'm not just saying that. Eric, on the other hand, he sees the stats. He knows the stats. He's like, dude, this is not good. So we'll see who's right. The lesson of tonight was for you to understand what a yield curve inversion is and why people keep talking about it. It keeps coming up more and more, although it's sort of lost its excitement lately because it's stayed inverted. It just will not go back to normal. What do you think? You think we're headed for a recession? I think, JP Morgan gave you a 60% chance. Goldman Sachs has a 35% chance of a recession. And they've actually lowered that number. Was it Citigroup, I think, was at 65%. Wells Fargo was at 65%. Gives you an idea what some of the big analysts are thinking. But give me a percentage. What do you think below? What percentage chance of a recession to where we have to go back to maybe not spending so much money? You know what I mean? That's a rant that I could go on, but for God's sakes, people are spending money like crazy out there. It's getting a little annoying. Anyways, I'll wrap it up there. I hope you learned something. At the very minimum, if you did, hit me with a thumbs up. Maybe you hit the subscribe button, you come back, you hang out with us a little bit. If I rubbed you the wrong way, yeah, that's going to happen at some point. I appreciate you putting up with us this long. And we'll see you tomorrow. All right? Enjoy.